One of the most important aspects of regional structure is the distinction between activities that sell goods and services to no residents, called here export activities, and activities that provide goods and services to local residents, called here no basic activities. So, first of all, let's introduce some new vocabulary here. When you say there's an export, in our context, we don't mean that a firm is selling necessarily to another country. What we mean is that the firm is selling to a buyer that is not located in the same region. For instance, since I'm working with the county of Murray and my example is a restaurant, if the restaurant I am studying, let's say that it has a client that came from Mainfield to eat at that restaurant. In that case, that restaurant will be selling to a client that lives outside of Murray. Therefore, that will be categorized as an export. On the other hand, if in that restaurant it serves a local resident, that's called a no basic sale, meaning you're selling to a local resident. Why is this one of the most important aspects of what we are doing here? Well, we will understand that better next chapter, but just to give you a hint, my main goal is to see if the region I'm studying is developing or not. If there's a new restaurant in the area and it sells food to a resident in the area, the county didn't develop at all because income just changed hands. It's not like there is new income in the region. The income changed hands from the client to the owner of the restaurant, but the local income is still the same. On the other hand, if somebody comes from Mainfield and eats in that restaurant, basically income was transferred from Mainfield to Murray, so there is regional growth in Murray. We will study that more in detail next chapter. Now, this section we are talking about empirical tools. So the idea is how do we identify, how do we measure a region's export considering all the industries, or how do you identify that? Now we're going to use the following reasoning, which is not necessarily valid, and it's the following. An LK greater than 1 means that some percentage of the employees in that industry are producing for export. Now the idea is the following. Let's say that 30% of the employees in Murray worked in the industry, but when you look at the overall country, only 20% work in that industry. So the concentration here is larger. In percentage terms, in Murray, 30% of the employees work in that sector. In US, just 20%. Since we are producing with more intensity than everybody else, we are probably exporting that type of good. We are probably selling to the outside of the country. On the other hand, let's say that 50% of employees in US work in manufacture. Only 10% of employees in Murray work in manufacture. Well, you are most likely buying manufacturers from outside of the region. Not enough people work in manufacture here or in Murray when compared to every place else. There's no way we are producing all the manufacturers we are consuming. And if the proportions are exactly the same, let's say that 50% of employees in US work in manufacture, 50% of the employees in Murray work in manufacture, we are going to make the educated guess that Murray is just self-sufficient. It produces all the manufacturers it needs, so it doesn't export and it doesn't import. With that in mind, we are going to use that same formula and make it equal to 1. Why? We are trying to establish self-sufficiency. What will be the exact proportion, such as the proportion of manufacturers, for instance, is the same as in the rest of the country. Now we are changing the formula, the letter E here, to SI. Why? SI is going to be my hypothetical level that will indicate self-sufficiency. The S is for sufficiency. Now, make that equal to 1. So for S, that's how I estimate what would be hypothetically the number of employees if Murray were self-sufficient in this industry, for example, manufacturers. Export employment will be then determined by EI, where E is the actual number of employees, minus SI, which is my estimated number of employees if there were sufficiency. If this number is positive, is producing to export, and if this number is negative, they're producing to import. And that is the amount of employees that represents this level of exports. Once we calculated that for each industry, how do you calculate total export employment in the region? We add up for every industry. You apply this formula here for manufacturing, for agriculture, for real estate and other financial services, and so on for all the codes in the NAICS, and then you add them all. That will be your estimate of regional export employment. It's not surprising that there are many critiques to that methodology. For instance, that's cross-hauling. What does that mean? In reality, Murray produces a lot of manufacturers and exports them, and also imports a lot of manufacturers, not one or the other. Like for instance, in Murray, we export a lot of windows and we import a lot of furniture. Also, this measure doesn't take into account labor productivity. For instance, if the labor in Murray is much more productive than every place else, we are going to have fewer employees working in this sector. But that doesn't mean we're not exporting. It just means that we require fewer employees because they are so productive. It is not also taking into account variations in demand, and there's also the fact that what industrial detail are you using? Are you using the 2-digit NAICS code or the 6-digit? If you use different levels, you're going to have different results. Also, we are not taking into account that U.S. exports a lot of its production. In reality, U.S. is an open economy, and when you use the U.S. as a benchmark, we are assuming it was a closed economy. On the other hand, there are many advantages to this measure. Local quotients are very cheap. When we are working in practice, one of the main challenges is to find data. Data on employment is available, so it's very cheap to calculate those estimates. We are going to see other ways to calculate them, and they are all very expensive. It's still an indirect estimate. It's like an educated guess, and you can apply equally to commodities and services. So not very accurate, but very flexible and very cheap. We were using so far US as a benchmark. In reality, usually you don't pick such a big benchmark. For instance, in the project that I'm working right now, we do not use US as a benchmark. We are using 35 other counties that somehow are similar to the county we're studying. They are similar in their classification as urban or rural, and they are similar in the number of residents. We look at these 35 cities, we took the median of all the variables we were considering, and that was our benchmark. The example in the book is the examination of, say, 10 cities of similar size. In this specific example, they are only chosen city based on the size of the population, but the selection may be based in other common characteristics such as location or income per capita. So we can choose a different benchmark. Once we do that, One alternative is to calculate the minimum requirement technique. The city with the smallest percentage of employment in one area would be presumed to represent the minimum requirement needed by a city to satisfy its domestic needs, and that would be considered the self-sufficient level instead of using US here. So you use here, instead of the level of employment in US in the industry divided by US employment, we use here the smallest percentage of employment in one area that will be presumed the minimum requirements here. So that will substitute the denominator here. If you have the money, instead of use these indirect estimates, you can conduct surveys to determine export activities. Basically, you survey each individual business and ask them, do you sell locally or do you sell to people that live outside the country? If you have resources for that, that will be much more accurate. Even in a small economy, conducting a survey, however, would be very costly. The LQ technique may be useful in targeting some industries likely to be exporters. Then, once you have your target industries, you can go ahead and conduct the survey. So the LQ technique is still useful. You may be willing to examine the level of concentration of industries in a region. For instance, does that region produce only one product, say tobacco, that is only economic activity, meaning that region will be very concentrated? Or are there many economic diversified activities in that region? So many different industries are there. What would be a measure of this industrial diversification? Well, there are different ways to calculate that. The book presents one. Step 1, calculate for each industry the difference between the percentage of local employment in the region and in the benchmark. Take the absolute value and add them up. In that case, notice that because you are considering all the sectors, this is a measure of the overall concentration in the region, not a measure specific to one industry. This is an overall regional measure. If all economic activity is concentrated in one area, this measure would be 1. So that will be really concentrated. If there are many different activities, this measure will add up. So we can compare that across different regions. Notice that the magnitude of the measure is not as important as when you compare different regions to see which one is more diversified. So it's an ordinal measure, not a cardinal measure.